Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer. Today, we're going to experiment with a slightly new format. I'm going to call it 3 Takes for Thursday. It's Thursday, May 15th today. And the 3 topics that I'm going to be covering from this week are UnitedHealth Group stock, the China tariffs, and some thoughts on that, as well as Warren Buffett's retirement and, something I think investors could think about that, and not just investors, but really everybody, and probably a take you're not going to hear anywhere else but here on the Cyclical Investors Club YouTube channel. As always, this is not individual investing advice, probably especially with these topics. So let's get into it. Let's start with UnitedHealth Group. So the fast graph, this is the price as of yesterday, $308 per share. But it was announced in the Wall Street Journal article today that the Justice Department may be investigating some what would you say, misbillings or something like that, miscategorization of billings, allegedly. UnitedHealthcare has said that they haven't heard anything from the Justice Department yet. It's down another mid-teens percentage today, down to $262 a share. So I thought I'd talk about this one first. I've covered this stock on the channel twice before. Once was a basic analysis. I think it was over a year ago. Just a basic valuation analysis back when the stock was doing better. And then at the beginning of this decline in mid-December, I made a video where I talked about kind of all these health insurance stocks. So I went back and watched most of that more recent December video, and everything I said there, I think still applies right now. During that time, my basic recession buy price for UnitedHealth was $204 a share, and now it's about $203 a share, and basically hasn't changed. And I always get, because I have these this was in December, right? Let's see what the price was in mid-December. It had started to fall a little bit here. I think it was the second weekend, more like this. So it was about $520 a share back then. I guess that's double what it is now. So it's fallen quite a bit since then, and my buy price hasn't changed. So, but I'll give you there's more than just the buy price, so we'll go from there. But we'll start there. So my buy price was based on, I like to buy stocks when they're cheap. Okay. It was based on this 2008 decline and how much the stock price fell relative to their peak earnings. Okay. So that's the very quick version of how I calculated that. You can watch those videos, especially the initial one. I have several videos where I talk about how I calculate the recession buy prices. So we have a similar situation where earnings are falling, expected to fall, I guess, and we have an established peak price. So all that's in, and probably the only reason my buy price went down a little bit is because they probably slightly missed expectations on earnings last year, because that went out in December. They probably reported like in January or something, and it was a little short. So that all stays the same, and the stock price is just behaving like it's in a recession, which for their industry might end up being a type of recession. Now, my last video on the whole group, which I'll link to down in the description, kind of goes through my overall thinking behind this. But the thing is, when the insurance head, I think CEO, was murdered, the interesting thing was the response from the public had very little sympathy, as far as we could tell. And the current administration, if they're good at anything, it's in picking up on public discontent, sometimes even if it's not understood or misplaced or imaginary. that doesn't really seem to matter most of the time if it's something that can be capitalized on politically. So it doesn't surprise me that if the Justice Department is going to go after UnitedHealth and probably the other insurance companies as well. And so that's a significant danger for them. And I think it's a real danger. And the thing is, all the cards are kind of stacked against these guys because we know that the the United States people pay too much for healthcare. Now, we might not be the healthiest people in the world, but the amount of GDP that goes toward healthcare expenses is just so much higher than everywhere else. And you can look and see that these are companies that have benefited from that. I mean, earnings were 3 something a share back then, and now they're up, in the $20s per share from 15 years ago. And, we'll call it tenfold over 20 years or something like that. So the U.S. economy hasn't grown that fast. The rest, people's wages definitely haven't grown that fast. And it just takes a bigger and bigger chunk out of, U.S. productivity that goes into healthcare expenses. And so nobody has any sympathy for health insurance companies in the U.S. And they're an easy scapegoat, even if they're not guilty of whatever there is. So that's all very negative. Now, we kind of had the same thing happen back in 2008 in 2009 when Barack Obama was elected. People thought we were going to nationalize healthcare, and that's why the stocks got so cheap back then. This could be a similar type of, industry scare, but I think it's kind of reasonable to treat it similarly as back then. So my basic philosophy is this, which I said in my last video. We know that all this news headlines are going to be bad, but we don't know how bad they're going to get. We do know earnings are going to come down, but we don't know how much. So we basically don't know where this earnings bottom is going to bottom out. But I have at least one reference, and that's 2008 to go back and look at. So my buy price, which has been the same pretty much this entire time, still holds basically, because I'm going to model, my expectations off that. And what that means is I don't want to buy until it's down at that level. I've seen some message boards and blogs where people have started buying this decline here, and they mostly regret it so far. If you talk about a falling knife, I mean, in 1 month it's fallen, more than 50%, I think. Oops. If I click the right points on here, we can see. Yeah. So we've gone, and that's not including today's drop. So in 1 month, down more than 50%. And everybody that's tried to kind of buy on the way down has gotten hurt. So one benefit of having very low buy prices is it gives you a little bit more time for this bad news to come out. Now, it does seem to me a little weird that UnitedHealth, they fired their CEO, got rid of them, and replaced him with the old CEO. So that happened just a couple days ago, or was announced a couple days ago. And now they say, well, the Justice Department hasn't contacted us about this investigation. But I promise you, if the Wall Street Journal wrote an article on it, the Wall Street Journal contacted them to ask them about it. So maybe the Justice Department hasn't contacted them, but they knew about it. It's not a coincidence the CEO disappeared, right? And so something is going on there. Even though nobody's lying necessarily, you don't just magically disappear your CEO, fire your CEO and replace him and then claim like nothing's going on, right? Or we don't know anything. So there's all that going on. So here's the way I have been approaching these, and I will continue to do so. I want this to get below $200 or $203 or whatever, and then I want the price to also be above the simple moving average. And this is what I showed in my last video before we had all this bad news back in December, which was right here. Okay. I want the price to be below $203, and I also want it to be above the 200-day simple moving average. So right now, the 200-day simple moving average is $537. But as time goes on, that will come down, okay? And we don't know where the stock is going to bottom, but if it doesn't at least get down to 203, then I know that there's still room probably to fall just based on history. It's not like a magical thing. It's just using history as a guide is a good way to have an anchor, so you're not one of the folks that bought this too early and has now lost a bunch of money. So the question is, well, if you would have done this in 2008 and 9, how would it have worked? And the question is, yeah, it would have worked. Well, it worked reasonably well. Now, it doesn't help you pick the bottom. So the bottom would have been actually in 2008, it looks like, probably October or November of 2008. But this orange line here is the 200-day simple moving average. And you can see that it did pop above it briefly here, but it was under $30 a share, several points during here, and also above the 200-day simple moving average before we even got to 2010. And, if you would have bought at that one of those prices, you would still be up tenfold even after this recent decline 10 years later, or however 15 years later. So yeah, you're not picking the bottom at 15. You're actually paying maybe twice as much, $30, but you have evidence that the market thinks that a bottom has probably been put in and some of the danger has been mitigated, and the market will probably be able to snuff a little bit more of this out than us individual investors at home, because they'll have a better idea what's going on in Washington. And with this time, it was Obamacare that was getting passed. So once they got a read on that, maybe in the summer, I'm trying to remember when that passed exactly, then you can, especially right in here, that's probably when the smart money was able to tell these guys are going to make a ton of money off Obamacare. So, and I was way too dumb back then to know that. I thought Obamacare was a bad idea, and I was one of the people that were worried the whole thing was going to get nationalized. And I went that route, and I lost gobs of money because now I was just at home an individual investor, and then I wasn't doing this professionally. But I definitely learned from that mistake not to let politics interfere with my investing decisions. And I try to stay that way. So even though I think, I don't think the administration, I wouldn't put much faith in the Justice Department to make any of the right decisions, or I think they're probably going to go with public opinion because it's just a win-win. Nobody is going to stick their neck out for these health insurance companies. They just aren't. So on anyone, basically. And so it's an easy target. But if it gets cheap enough and it looks like it put in a bottom, and we still have private health insurance, I'll probably be a buyer, and that's how I would approach that one. So that's my thoughts on UnitedHealth. I've had more questions on this one than anything else. All right. Take number 2 is going to be on the China tariffs. And the most interesting thing that we raised tariffs to 100 something percent. China responded, and then we raised them more to like 145%, and then China was up to like 125. Mostly a trade embargo, I would say. Ships started, not coming to port, and so then they meet. We have a reduction. Well, first, the bond market put a stop to the initial tariffs on everybody else. Right, that's when the real delay came. So this is what I think is the most interesting about this. The 10-year Treasury, it was a few days after Liberation Day, they had an auction that supposedly went well, but basically caused the administration to back off all the tariffs, except for the Chinese ones. And that it hit about 4.5% yield on the 10-year Treasury at that point. And so that was enough. And then whatever other difficulties were going on behind the scenes to back off and delay all these tariffs for 90 days, except China. So now we have China left to deal with. Everybody with any brains knew it was going to be a total disaster. We were able to buy a lot of stocks. I made several videos, even on the YouTube channel during that time, because at least some of the tariffs, it's just we're not making shoes in America. Like I made a video on Deckers. There's just some of these things just aren't going to happen. So you don't have to be smart to figure that out. But so we still had China to deal with. So then we have the China meeting. We get a reduction of tariffs for 90 days from both sides. Still higher than they were, but not embargo level high. And the market took off, which was great. The Cyclical Investors Club portfolio hit an all-time high this week afterwards, and and you get a preview at least of what will happen whenever we do put a bottom in, right? So you can kind of look at how your portfolio performed. What did you do during the downturn? What did you buy? What happened to them on this bounce? I don't know if it's sustainable or not. The same stocks that rallied could fall again, but we get an idea of what the market could do when a real bottom is put in, if that's not the real bottom. But what I find most interesting is the 10-year. So during this rally, the 10-year treasury, let's go here and see if I can. So the 10-year is right at the level okay, it fell a little bit today. It actually fell quite a bit today. But earlier this morning, it was at about 4.5%. That's about the same level it was when we decided these tariffs weren't going to work the way that we thought they were. And so that should be a little bit of and now the market is down a little bit today. That should be a little bit of a warning sign, I think, that this is not going to be probably like a big, huge making new highs type of a rally. People basically it looks like they took money out of the bond market, put it into the stock market, which raised the yields. And today the market's down, and now yields are down. That means bonds are up, at the 10-year anyway. So we have the 10-year yield, which I've thought for the past 6 months. I mean, ever since, the election especially, and we kind of got to see what was coming. That was going to be the problem for the administration's plans all along. And they've been very creative. I mean, I figured they would. They've been very creative with their methods of trying to get it down. And it worked briefly. But they've hit wall after wall trying to execute this. I don't want to I have my thoughts on what they're thinking, but they kind of change. So it's almost, you can't even really talk about them. But I know they want the 10-year lower. And because they need that for the economy to work, they want to term out the government debt because we got view of this tax bill, which is another reason why the yield went up. And it doesn't look like all the budget cutting is going to be much of a cut. So when this is all said and done. And so the bond market is sniffing that out. And the problem is you just can't balance it all and promise and fulfill all the it's politics as usual in that degree. But sometimes people are more willing to believe things politically that just the math just doesn't work, right? And the 10-year is where kind of the rubber meets the road. And it's telling us that it's going to be hard for all this to work in Goldilocks land, right? So I think investors should still be pretty cautious and selective. I still have a third-ish cash, maybe a little bit more than that I'm willing to invest in the downturn. We saw during the previous one, I'm willing to buy. We rallied strong out of that on the stocks that we did buy. So, all is not perfect, even though, and these are all 90-day pauses. So this is going to go on and on for a while. 90-day pauses to get to some kind of verbal understanding or agreement, not a real deal. So you kind of have to ignore what's being said, know the prices you want to pay for the stocks that you want to own, have some cash, and when the stocks hit those prices, again, ignore the news and buy them. That's what I'm trying to do. So that's kind of my thoughts on the tariffs, and everything really come down to the 10-year and the budget and everything. Like, it all comes together at the 10-year treasury yield. So watch that. It's been a good kind of truth detector lately. Okay, last item. Warren Buffett tells the Wall Street Journal he stepped aside as CEO after finally feeling old. So this article just came out yesterday, but Warren announced at the Berkshire meeting last 2 weekends ago, I guess, a week and a half ago, that he was finally going to be stepping down as a CEO at the end of the year. He turns 95 this year. And this isn't really about Warren Buffett. It's more about other. What it reminded me of was there's tons and tons of focus on retirement and investing, right? Because we're kind of put in a situation where we have to save and invest so that we can stop working someday. But I think what Warren Buffett should remind people of is that you probably should think of retiring differently, I think, for a lot of people or some people. He kept working, I would say, and this article is interesting because he says until about 90. He didn't feel old until he was about 90. So in the normal retirement age is 67-ish, we'll call it, on average in the U.S. now. Now, people usually retire earlier than that, which goes to my point. The retirement professionals will talk about, especially the YouTubers, will talk about like the 3 phases of retirement. You have the go-go years where you're out doing all the things that you can do because you don't have to go to work anymore, traveling and all that stuff. The slow-go years where you can still do a lot of the things that you wanted to do, but maybe you just don't have the same kind of energy that you used to or something, or to be out, traveling the world and things like that. And then the no-go years where you're just really kind of worn down. I would say what Buffett's saying is he kind of hit the no-go at about 90, right, for his job. So he and honestly, he probably, most of the day-to-day stuff he's probably pushed off at that point or delegated to the other CEOs at Berkshire. So if another YouTube rabbit hole you can go down are people being laid off from their jobs and having a difficulty getting the same kind of job. And this is probably going to happen even more, I think, if we have a recession. Although with immigration lacking, maybe it won't be, the dynamics could be different. I turned 50 this year, so Gen Xers, you'll see a few posts every now and then where they're in their 50s and looking for a job because they company downsized or something and having difficulty finding something in their, getting hired basically for the job that they had done before. And I think that's something people really need to think about not retiring is the point I'm trying to get at. A plan to not retire, but to have more independence so you're in charge of your retirement. I mean, Buffett was CEO of his own business and he owned many other businesses. So nobody could make him retire. He got to choose that for himself. I think people should be aiming for that. I don't necessarily think public, even though this is my job, maybe because it's my job. I mean, I don't know that public markets are the best way to put all your eggs in that basket for retirement, or to replace like your normal job. So in some ways, I think, you need to kind of, I'm not giving anybody advice, but you should consider thinking about, you don't have to work as hard. You don't have to work full time, but consider, starting some kind of your own business, even if it's a small business. It doesn't take much to supplement, the other types of investment income, maybe rental property income, Social Security, to do a job that you actually want to do. And I mean, I think by the time a person gets my age, they should really be thinking hard about that. There's a book that I think about a lot when I think about people getting laid off from their jobs. So it was written in 1939, French author. The American version is called Wind, Sand, and Stars. It's a fantastic book about an airplane pilot, and just the development of airplanes. And, you think of airmail and things like that. And in the 1930s by Anton de Saint-Exupéry. I know I didn't say his name right. But anyway, the book is fantastic. So there's a scene in it where, and I'm going from memory, it's been a long time since I read it, but it stuck with me. He's in the Sahara Desert, at a place in the Sahara Desert, and this is in before the 1930s. It's probably 1920s, 1930s. And they still had like slavery there, like just outright slavery. And he tells the story of an old slave who, basically what would happen is once the slaves got old enough at a certain age, they just weren't very useful anymore. Their masters would just turn them out. They say, okay, you're no longer a slave, you have your freedom. And the slave would then, go around, they were old, and not very productive. They would go and beg other people to, take him as their slave. And nobody really wanted him. And eventually he just walks out into the desert and just dies, of thirst or starvation or whatever. And I think about that when I think about people getting laid off from their jobs in their 50s and not being able to find a new one that's similar to what they had before, where most people are being pushed. They're almost always pushed into retirement earlier than they wish because there's cheaper, younger, there's all kinds of reasons why corporate America would do that. So starting your own business of some sort, even if it's very small, in your 50s or sooner, I think is a good idea. And that might be one of the big, and then you don't have to retire. You can choose something that's not manual labor, or super intensive, maybe where you have free time to also do the things that you want to do in your life. And when you combine that potentially with your investments and, any pensions or anything, then you can have a pretty good kind of semi-retirement until you get all the way to the no-go years where you really are retired, like you're really just done or close to it, And so that's what I think. It's kind of a bigger picture thing that maybe people should think about, that I thought about when I put together the scene from Wind, Sand, and Stars, and then Warren finally retiring and then saying that he didn't really feel old until about 90. So, and I think Warren's had a pretty good life. Now he's an extreme example, but, having more control of your own destiny, I think is important. It's important for what I do, because I want individual investors to be good investors instead of putting their life in the hands of money managers or just index funds where they really don't ever learn what they're actually doing. That's probably better than putting it in the hands of a corporation, but still not as good as if you know really what you're doing. And then I really don't even think putting all the eggs in the public markets basket, even if a mix of stocks, all the stuff, like there's not nearly enough talk about supplementing that with a business of your own, where you have a real mix of things. So you're not totally dependent on even public markets, because they can be very bad for long periods of time. And usually it happens after times like we're having right now. And so I think that danger is pretty high. So even for what I do, I think it should just be a portion of a person's retirement. And we have a real attitude, I think, when it comes to the investing world of just stocks and bonds are it. Now you see a lot of people on there talking about private markets, but that's only because they get to control the money for you. It's not you investing in private markets, right? It's them investing your money for you where they take a fee. And part of that's because the public markets are well, they're difficult to get good deals in right now. And so people are kind of being pushed, I think, into private markets, which might not be any better. They're just not mark to market, so they can hide the returns better. But at any rate, some things to think about on my 3 takes for Thursday. Let me know how you like this format, and I'll see everybody later.